So under the capital structure theories, we say the different theories. We have the traditional theory, we have the net income approach, we have the net operating income approach. And just remind ourselves that what we say that under net income approach, the most important thing was that the assumptions, no taxes. Taxes don't exist. And we said these theories exist to explain the effect of debt financing to the value and WSEC of a firm. So I need to compare the WSEC and the value of the firm without debt. That is the unlevered firm. And we ask ourselves, what if debt is introduced? How will it be? So for the unlevered firm, the value of unlevered firm, we said equals to value of equity of unlevered firm, which equals to, can either use number of ordinary shares, we multiply by the market price per share. Simply how to calculate the value of ordinary shares, the number of shares times the price per share. Anytime you're talking about the value, what is more important is that anytime you're talking about the value is always about the market value. So number of shares times the price of one share, we get the total value. Alternatively, value of the unlevered firm, which equals to value of equity of unlevered, can also be calculated using the formula EBIT divided by the cost of equity of unlevered. And what we said about the net income approach, taxes don't exist. I know that for me to arrive at the profit after tax, I'll get EBIT, I will less interest. EBIT minus interest, I get profit before tax. I adjust for tax. I get profit after tax. If I have the preference shares, I less the preference dividends. But again, among the assumptions of capital structure theories, preference shares do not exist. The firm can only be financed by debt and equity. So for the net income approach, most importantly, number one, taxes do not exist. More importantly, taxes do not exist. And of course, if taxes do not exist, then E1 minus T itakuwa 0. Then unlevered firm has no debt, meaning there'll be no interest. So profit after tax for the unlevered firm is the same as EBIT because it's EBIT minus 0 into 1 minus 0 in a bucket to EBIT. That's its EBIT over the cost of equity of unlevered. Now,
I have a
for
question.
the WSEC, yes.
I'm asking now that you have said that there is no assumption is that there's no preference shares. Even in a question, I find it so I have to assume, or you are saying I subtract.
If you get the preference shares.
Yes, if in a question, then maybe there is a preference shares.
If you get preference shares in a question,
yes,
it's a very rare occurrence. The question will be vague. That question will be vague, but again, examiner has his way of testing people. We know very well that under the capital structure theories, preference shares do not exist, but he can ask you by considering preference shares also, calculate the value of the levered firm and the value of unlevered firm. Then in that case, amekuambia yes, it's true, they should not be there. But again, and he's instructing you by considering preference shares. So hapa itabidi less nini? Preference dividends.
Yes.
Okay. Vile ameiput by considering preference shares also, because in his mind, he knows that they should not be there. But he's giving you instructions, and in an examination scenario, you follow the instructions. You don't question the examiner.
Another question. since you have said that there is assumption of this net income approach is that it doesn't have the taxes do not exist. Now, what is the need
Yes.
of having there? Because if you say it doesn't exist, and then we say it 1 minus t, which is that in bracket is 0. So let's say now I have interest and bracket is 0. Or I have to assume that formula to get rid of it, not to appear anywhere. 1 minus t. Am I supposed to just leave it?
Bracket will not be 0. Bracket will be 1 minus 0, which is 1.
Okay, thank you.
So bracket will be 1 minus 0, which is 1.
Okay, thank you.
So it is the reason I put it here is just to appreciate the value. The value is always part over cost of equity. And I explained it here by saying part that we are looking for under net income approach will be the same as EBIT. Because interest is not there, this will be 0. So it will be EBIT minus 0
into 1
right?
minus 0. Yes.
Then we are just into 1 minus 0. So nona tunabaki na EBIT peke yake.
Yes.
But tukisema by considering preference shares also, then the value of unlevered farm will be EBIT minus preference dividends. I don't know if you're seeing that.
You are saying?
If the examiner becomes vague, the way you've asked a question, what if you've been given the preference dividends and the examiner says by considering preference shares also? Then you know whether we are levered or unlevered. For the levered farm, if for the unlevered, if it has preference shares, you less the preference dividends. If it doesn't have, then you don't less.
Okay.
But the formula under the assumptions that exist is EBIT over cost of equity. Unless examiner now decides to complicate our life. Sasa. Okay. Then when you go to the WSS of unlevered farm, will be the same as the cost of equity of unlevered, which equals to, it's just a matter of making this the subject. So if I make cost of equity the value of equity of unlevered. So just making K with the subject of this formula. Hope that's okay.
Okay.
Great. Then we go to the levered farm. We got the levered farm, and remember, a levered farm has both debt and equity. It has both debt and equity. Now, the value of the levered farm equals to value of equity of the levered farm plus the value of debt. So kama tungekuwa na preference shares, then again, the way you've asked, we shall also add the value of preference shares, which is very rare because of the assumptions that exist. Capital structure theories, preference shares do not exist. So value of the levered farm is value of equity plus value of debt. And how do we get the value of equity of the levered farm? Just like it was here, EBIT. And by the way, the formula is always profit after tax over cost of equity. Profit after tax divided by cost of equity of the levered farm. Now, profit after tax for the unlevered, we just explained here that profit after tax will be the same as EBIT. And fact, I can put it here. Profit after tax will be equals to EBIT. Under the unlevered farm, remember? Nimerudi nyuma kidogo. But now here, the profit, yeah, because haina interest. Ndio it may explain hapa.
Yes.
Because haina interest, profit after tax yake ni sawa na EBIT. Now, tukikuja kwa levered farm, for us to get the profit after tax, we shall take the EBIT, and because we have debt, we less interest. We less interest. Taxes do not exist, so 1 minus T is 0. Preference shares do not exist, so profit after tax is EBIT minus interest. So for that reason, the value of equity of the levered farm equals EBIT minus interest, and we divide by cost of equity of the levered farm. Okay, and again, if you've been given the number of shares times the price per share, you can also apply that formula here. So value of equity of the levered farm can also be number of ordinary shares times the price per share. It all depends, you work with the information that you've been given. To get the value of debt, we simply get the number of debts times the market price per debenture times the price per debt. And in most cases, or mostly, debt is issued at par. Hence, its value would be equals to the par stroke book stroke nominal value. So mostly it's issued at par. I think that one we talked about. Tukifanya the WSC, WMCC. When you go to the WSCC of the levered farm, WSCC of the levered farm, this one equals to weight of equity times cost of equity plus weight of debt times cost of debt. Taxes do not exist. So weight of equity and the weight of debt, we shall get it from the values. Value of equity plus value of debt. So weight of equity is the value of equity divided by the total. Weight of debt, the value of debt divided by the total. Now, the cost of equity of the levered farm from this formula, we can make KEL the subject. So it becomes EBIT minus interest divided by the VEL. So EBIT minus interest, and everything we divide by the value of equity of the levered farm. Just playing around with those formulas. So here ni make cost of equity the subject of this equation, of this formula. If I'm going so fast, you say, and of course, KD equals to interest. Interest divided by value of debt. And just as I said, pale juu, if debt is issued at par, KD equals interest rate. Panga interest ama coupon rate if debt is issued at par. Now you can think we can check that question. It was 2013?
It was 2023.
2023.
Yes, question
Let's check.
December 2023, question 1P.
Question 1B.
Yes.
So question 1B is about Modigliani and Miller. Let me try see if I can get the one for net income approach. Hiyo ni ya MM. It is the same as the net operating income. There's a question that was tested for net income approach. I think somewhere in 2019. Can go there and see. It's 2021. So that's 2020, 2019. Yeah, November 2019, question 4B. So I can check that one out. November 2019, question 4B.
4B. Okay.
Yes.
Now, property A.
Yes, property A and property B are categorized under the real estate category. Property A is all equity financed, while property B is financed partly using debt and partly by equity finance. So you can see property A is all equity financed, meaning property A is unlevered, while property B is financed by debt and equity. So A is unlevered, B is levered. Both properties generated operating profit, that is EBIT, of 41 to 45,900 annually. So you see where the examiner starts us from, EBIT. In most cases, he doesn't give us the profit after tax. So that's why it's important to note that profit after tax for net income, profit after tax in absence of debt is the same as the PAT. So both properties generated EBIT of 41 to 45,900 annually is expected to remain constant each year in perpetuity. Unlike A, which is wholly equity financed, property B is financed partly by equity and partly by 10% debt of shillings 215 million. So that is the value of debt. The cost of equity is 12% for both properties, and there are no corporation taxes. You see that each unit of debt is trading at par. So no taxes exist, and that's why we're being asked the current value of each property using net income approach. So net income approach, taxes do not exist. So we can start with property A. And because you're learning, we shall do both. They want us to calculate the value, but we shall also do the WSCC for the sake of learning.
Yes.
So property A, when you start with the value of A, the value of property A. Remember, property A is unlevered. So value of A should be equals to value of equity of A, which equals to profit after tax divided by the cost of equity of A. And the profit after tax for the unlevered firm is the same as EBIT. We divide by cost of equity of A. Hope with that flow it makes sense.
Yes.
Great. So do we have EBIT?
Yes, we have 41 to 45, 900.
So 41 to 45, 900. That is our EBIT. And the cost of equity is how much?
Cost of equity, 12%.
12%.
Yes.
And as simple as that, tunapata your marks. So let me do this. Hey, namna hiyo tu. So therefore, it is equals to EBIT divided by cost of equity. And that is the value of A. That gives us the value of A. Just as we said, we can also look at the cost of equity of A. WSEC of A, sorry. WSEC of property A equals to cost of equity of property A, which equals to 12%. As simple as that. Tushapewa cost of equity, kwa hivyo hakuna haja ya kucalculate tena. You already have it. Okay.
Okay.
Then we look at property B, and property B is levered. We start by answering the question. They wanted us to get the value of B. So you know that value of B, which is levered, equals to value of equity of B plus value of debt. Do you have value of equity of B?
Value of equity, yes, 12%.
Hiyo ni cost, hiyo ni cost.
God, no, so. Value of equity, yes, 10%.
Value hizi ikakuwa percent. Formula yetu bado iko profit after tax divided by cost of equity of B.
That's my cost of equity. Yeah.
Sindio?
Yeah.
And because we have debt, the part will be EBIT minus interest. That will be the profit after tax. And we divide by the cost of equity of B. You see that?
Yes.
So do we have EBIT?
Yeah.
41
to 45 to 45, 900.
900 minus interest. Interest is what percent?
10%.
10% of how much?
Of 215,000. 215 million.
Of 215 million.
Yes.
So that gives us EBIT minus interest. And everything we divide by the cost of equity. Both companies had a cost of equity of 12%. So that is it. So therefore we have, let me use Excel to get this one. So equals to 41,245,900 minus 21.5 million and divide by 0.12. So that gives us the value of B.
253. I'm getting a different one.
You're getting how much?
I'm getting 253, 050, 492. I think division.
Let me see.
10%.
This is 41 to 45, 900 minus 10% of 215. Okay. 253. Hebu angalia vizuri from your end.
Nione vizuri. Ngoja kwanza. 10%. 215. 10% of 215 million, si ndio? And then I less 41 to 45, 900. And then divided by 0.12. I'm getting something different. In
So,
calculation error.
41 to 45, 900. Do in your calculator.
Yes.
41 to 45, 900 minus 21,500,000. The answer that you get should be this.
164. I'll revisit.
Should be 19,745, 900. Then you divide by 0.12, you get 164. You'll revisit that one. Cindy?
Oh, yes.
So that is the value of equity. So you need the value of debt. So hatujamaliza bado. The value of equity plus value of debt. So value of debt, it's selling at par. Hata wametuambia selling at par, which means value of debt will be equals to the par value, which equals to the value, it was 10% of 215. So therefore, value of B becomes value of equity ambayo ni 164,549, 166.67 plus the value of debt ambayo ni 215 million. So there we go. So that is the value of B, and you have value of A pale juu. They wanted us to get the value of A, and they also wanted us to get the value of B for 4 marks. Now, B, let's also get the WSEC. WSEC of B which equals to weight of equity times cost of equity plus weight of debt times cost of debt. Do you have the cost of equity of B? The answer is yes, 12%.
Yes, you have 12%.
Do you have the cost of debt?
Yes,
Selling
10%.
at par, 10%. Taxes do not exist. Can we get the weight of equity? The value of equity divided by the total.
Yes.
So therefore, WSC would be equals to value of equity is 164, 549, 166.67 divided by total of 379, 549, sorry, 166.67. And this one we multiply by the cost of equity, which is 12, plus the weight of debt, 215, divided by the total, which is 379, 549, 166.67, times the cost of debt ambayo ni 10. Let's see if the formula will accept. Sawa, sawa, sawa.
I'm getting 10.86.
10.86.
10.87.
10.87.
Yes.
Great. So 10.87. So that is the WSCC. Now, in looking at our, so how capital structure, now what it means, what this topic means is now about comparing the two. Without debt, the value of the farm was 343,000. When we introduce debt, because everything else remains constant, EBIT is the same, cost of equity is the same. Bila debt ni 343 million. When with debt, a farm that has debt under the same circumstances, the value is 379,000. The alternative, the other option, the cost without debt, the WSCC is 12%. When debt is introduced, the WSCC is 10.87%. So you can see by introducing debt, the value goes up, the cost reduces. And at any given point, the objective is always to maximize the return or to maximize the value and to minimize the cost. So debt is good. Debt is good. So capital structure theories are relevant. Why are they relevant? By introducing debt, the value goes up, the value of the farm increases while the WSCC reduces. And that is always the case under net income approach. Capital structure theories are relevant because debt has an effect on the value and WSCC. So net income approach is rarely tested. Ilitestiwa hapo. Unless kama kuna swali.
Kuna it's clear.
Oh, clear. So let's say something on net operating income. Net operating income approach, NOI. But the deadline ya kulipia mtihani ni kesho, you're aware, right?
Yes.
Okay. So NOI, net operating income. NOI. So you can say this. Under this approach, under this approach, in absence of taxes, debt financing has no effect on the value and WSCC of the firm. So under the net operating income approach, inasema kuwa, yes, again, just like the net income approach, taxes do not exist. Taxes do not exist. And because taxes do not exist, ikasema pia kuwa, when we introduce debt, it will have no effect on the value or WSCC of the firm. According to NOI, value of unlevered firm will be equals to value of the levered firm, which equals to EBIT divided by WSCC. Sasa hapo ndo penye challenge huanzia. Kila capital structure theory iko na approach yake. Kumbuka net income approach, value of the levered was different from the value of unlevered. Value of unlevered was the value of equity, which is
That's value.
value of the levered was value of equity plus value of debt. Value of unlevered was simply value of equity. But sasa hapa tunasema debt does not affect the value, neither does it affect the WSCC. And for that reason, whether we have debt or we don't have, value itabaki constant. And also WSCC of the unlevered firm is the same as WSCC of the levered firm. Which you can get it as value of the firm divided by EBIT. And of course, this theory is similar to MM1. Without taxes. So this point is very important. When you talk about net operating income, is the same way as talking about the Modigliani and Miller one with no taxes. And that's why we were able to look at a question year ya 2023 na ilikuwa ya M1. So we can go to that question and we see. It was December 2023, if I can remember. So December 2023.
Question 1.
Question 1B. So I can see part 2 is asking about arbitrage process. Arbitrage process, do we need to talk about it right now, really? No, we need to talk about it tukimalizana na capital structure theories. Now, in a study carried out by a financial analyst, EBIT of Papa Limited and Kaka Limited was found to be 10 million. So now EBIT equal constant, 10 million for each company. Papa Limited is fully equity financed, while Kaka is financed partly using equity and debt. Capital structures of both firms are given as follows. So you can see Papa Limited is unlevered. Kaka Limited is levered. Both firms adopt 100% payout ratio as their dividend policy. Those are the assumptions of capital structure theories. Payout ratio is 100%. All profits are paid out as dividends. Cost of equity of Papa Limited is 10%. Then you're being asked, using Modigliani and Miller proposition in the absence of taxes, next time they can bring a question like that, then they say, using net operating income approach. So the language is still the same because tumesema NOI ni sawa na MM1.
Yes.
So they want us to get the cost of equity of Kaka Limited. Now, under NOI stroke MM1, WACC of the levered firm is the same as WACC of unlevered. So WACC of Kaka will be the same as WACC of Papa. Right? And again, we can ask ourselves, the WACC of unlevered firm, in our case is Papa, equals to cost of equity of unlevered firm. And in case, what is the cost of equity of Papa Limited? 10%.
Cost of equity is 10%.
10%. So meaning 10% will also be equal to the WACC of levered firm ambayo ni Kaka. So therefore, WACC of levered firm, which is Kaka, is also equals to 10%. Hii mambo ni kufikiria tu. And for Kaka Limited, do I have the KD? I
Cost
think
of yes,
5%.
yes.
Do I have value of equity?
Value of equity.
I think 70.
Yes, 70.
Do I have value of debt?
Value of debt. Yes, you have 50.
Meaning total value becomes 70 plus 50,
Plus 50.
which is
120.
120. So therefore, WSEC, weight of equity times cost of equity plus weight of debt times cost of debt. So weight of equity is 70 divided by 120.
120. Yes.
Times KE that we don't know, plus weight of debt 50 divided by 120 times, what is the KD? 5.
5.
Equals to 10%. Can we get the KE? So 70 over 20 times KE equals to 10 minus that. 10 minus these. So KE becomes 120 divided by 70 times this. If I cross multiply, I think 13.57%.
Yes.
Na hiyo ni max yetu 3. It's just being creative and understanding the concept. Once you're able to understand the concept, then life becomes easier. So when you're told to comment on the equilibrium position on the value of both firms, point of equilibrium is the point of indifference where the two values are the same. So if they're asked to comment on the equilibrium position, we'd simply say equilibrium arises when the value of the levered firm will be the same as value of unlevered firm.
Oh dear.
Equilibrium arises when the value of the levered firm will be equal to the value of unlevered firm. So the point of indifference where you're not able to say that this company is doing better than this one, hapo tumefika equilibrium. So it arises where the value of the levered firm is equal to the value of unlevered firm. Mama is the same. Then you say the value of levered firm, into brackets Kaka Limited is expected to reduce. The value of levered firm into brackets Kaka Limited, close the brackets, is expected to reduce while the value of unlevered farm, into brackets Papa Limited is expected to increase. Due to market forces of demand and supply. Due to market forces of demand and supply. So remember what do we mean by market forces of demand and supply? Remember, Papa Limited, the unlevered farm value yake iko chini. Value ikiwa kidogo, many investors come in to invest. So the demand goes up because it's cheap. When the demand goes up, many investors will come to invest, and eventually by having good traffic of people coming to invest in that company, the price will automatically go up because of the higher the demand. Then for this other company, it's too expensive to invest there. So those who are already there want to sell because it's good to sell. Those who already invested there want to sell their investments. So the supply is high, the demand is low, so the price will drop. So for the levered farm, the price drops. For the unlevered farm, the price goes up, just due to the market forces of demand and supply. So you say that and you get your 4 marks. So here, arbitrage process. So you can finish with this one. So calculate the arbitrage profit. So just write a subtopic on arbitrage process.
Arbitrage process.
Yes, arbitrage process. We say it is the process where the investor takes advantage, of the difference in the value of the difference in the value of the farms. The investor takes the advantage of the difference in the value of the farms so as to earn a riskless profit known as arbitrage profit. So steps. So steps of calculating the arbitrage profit. So step number 1, investor in overvalued farm. Overvalued ni sawa na levered. Sells his investment in equity of the farm. That farm is always levered because who investor investments zake ziko kwa levered farm. So na sell his investment in equity of the levered farm. So that's step number 1. Step number 2, Step number 2, investor then borrows on personal account amount of debt equal to his investment in levered farm. So he borrows on personal account amount of debt equal to his investment in levered farm. Then step number 3, all the amount raised is invested in undervalued farm. The undervalued farm is the unlevered. Is the unlevered. Whatever you the proceeds from the sales that you made, you're going to invest the whole of it in unlevered farm. And finally, step number 4, you determine arbitrage profit. Arbitrage profit. So let's follow up with the 4 steps and answer and get the 4 marks there. And anytime you're talking about arbitrage process is always available to somebody who is invested in the overvalued farm, not undervalued. It's always available to an investor in overvalued farm. Like you see, calculate the arbitrage profit for shareholder holding 10% of the shares of Kaka Limited. Kaka Limited ni gani? Ile iko unlevered. Value yake ni ngapi? 70 plus 50, which is 120. Ingine value yake ni ngapi? 100. So it will always be available to somebody invested in overvalued farm. So therefore, in answering this question, so we started the step number 1, proceeds from sale of investment in shares. Sale of investment in equity. Let me call it equity the way it is. Equity of Kaka. So what is the share of this person? And a whole 10%. So atauza 10%. What is in share yake? 10%. The value of equity pale juu ni 70 million. So 10% of 70 million, that becomes 7 million. Then we add amount of debt borrowed. So you borrow on personal account amount of debt equivalent to your investment in that farm. So investment yake ni 10%. Na debt iko hapo kwa hiyo kampuni ni 50 million. So therefore, you're going to borrow 10% of 50 million, which is 5 million. So therefore, that gives us the total amount to invest in paper, and the total amount to invest in our case will be 7 plus 5, which is 12 million. 12 million. That is 12 million. Now, after having the 12 million, we take all the 12 million and go invest in Papa Limited. So we ask ourselves, how much do we get in Papa Limited after investing the 12 million? So what is the gross income in Papa after arbitrage? So the gross income in Papa after arbitrage. So nile unajiuliza, the value of Papa is 100 million. Na profit ya yenye iko kwa Papa, profit access kumbuka na ina debt. So profit yake ni sawa na EBIT. Tulikuwa tumepata profit yake na ilikuwa somewhere 10 million EBIT. So in the long cut inakuwa unajiuliza, kama the total value of 100 million is giving us a profit of 10 million, how much profit am I going to get if I take there my 12 million? So if a value of 100 million is giving us a profit of 10 million, how much profit am I going to get if I take their 12 million? And that one, you take amount invested, divide by value of the unlevered farm, which is Papa, and everything you multiply by the profit after tax of the unlevered farm. Now kumbuke profit after tax ni sawa na EBIT. So therefore, amount invested is 12 million. 12 million divide by the value, which is 100 million. And this one we multiply by profit after tax. Profit after tax yetu ni ngapi? Ni sawa na EBIT, ambayo in our case ni 10 million. So equals to 12 divided by 100 times 10 million. So that gives us the gross income before the gross income after the arbitrage, that is 1.2 million. Then we come ask ourselves, can we less hiyo pesa tuliweka huko yote? Kuna ile tuliomba. So less interest on amount borrowed. How much did we borrow? We borrowed 5 million. So 5 million. What is the interest rate of that debt? The interest rate of that debt was 5%. So 5 million times 5%. So equals to 5% of 5 million. So therefore, we have our net income. Net income in Papa after arbitrage which is the difference now. So hiyo ndio income atakuwa nayo baada ya arbitrage. Alafu tunajiuliza kama angebaki huko kwingine bila kudiversify, ange make income ya ngapi? So kama unless net income in Kaka before arbitrage. Net income in Kaka before arbitrage. Just the same way, Kaka alikuwa na control 10%, so it's 10% of the profit after tax. 10% of profit after tax of Kaka. So that is 10% times, what is the profit after tax? EBIT, tuko na 10 million minus interest. Interest is 5% of 50 million. Kumbuka hapo, kumbuka hapo sasa, the firm is levered, ili ifike the profit after tax, we need to less interest. So therefore tuko na 10% of 10 million 10% of 10 million minus 5% of 50 million. Minus 5% of 50. So you see, that is the net income. Kama angebaki huko kwingine, angeendelea ku earn 750. Lakini kwa sababu aliyekuja huko kwingine, ali earn 950. So can we have the arbitrage profit? So what he's currently earning minus what he was earning prior to that. So that is our arbitrage profit. Aka kakitu kwa kanasumbua watu.
Very tricky.
Yeah. Hii huwa inasumbua watu. Watu wengi huwa wanakwama kwa step number 1 na 2, step 3 na 4. Kwanza step 3 huwa inawasumbua sana. In fact, most of my colleagues don't teach it. Wanasema hiyo ikikuja wachana nayo. Tafuta marks kwingine.
Very complicated.
So we can all appreciate what that one needs. It needs somebody to go through it more and more. Sindio?
Ndio.
Hiyo inataka kupitia. Ndio isync.
You'll get me the one which is related.
The one which is?
Which is related to this. A question what that was tested for this arbitrage. You find one, you will look forward to me so that arbitrage.
Yeah, I'm going to check just after we finish this. Then I'll check and forward. I don't know if I'm able to get one. So, beta coefficient. So let's have the part C is MM2. Allow me to introduce MM2 just to highlight the formulas. Alafu tuzichangamkie. MM2 is notorious in the exam, and we're gonna formulas a little bit unique, not technical but unique others. So MM2 inasema with corporation taxes. Good, with corporation taxes. Then we say MM argued that in presence of taxes, a levered farm will enjoy some tax benefits. Some tax benefits associated with debt financing. It will enjoy some tax benefits associated with debt financing. So therefore, we can start with unlevered farm. Unlevered farm. So value of unlevered farm equals to value of equity of unlevered. I believe that bit now we appreciate it very well. Value of unlevered farm is the same as the value of equity of the unlevered farm, which equals to profit after tax divided by the cost of equity of unlevered. Vile tu ile ingine ilikuwa. But now, remember in this case now taxes exist, even though debt is not there. I know that ili nipate profit after tax, I'll take EBIT and I'll subtract interest, which is not there in our case, and we adjust for tax into 1 minus T. Remember, this farm is unlevered, because your interest is not there. So which means the value of unlevered farm, which is equals to the value of equity of unlevered, will be the same as EBIT into 1 minus T. And we divide by the cost of equity of unlevered farm. Right? Kosawa?
Yes.
Good. Alternative, the value of unlevered farm, which is the value of equity of unlevered, can also be equals to number of ordinary shares. Number of ordinary shares times the price per share. Kama tuko kwingine vile ilikuwa. Then you talk about WSCC. WSCC of unlevered farm is the same as the cost of equity of unlevered farm. And from this formula, I can make cost of equity of unlevered farm the subject. levered farm. I don't know where our interaction stopped. Nilijipata tu niko peke yangu.
Work of unlevered is equals to cost of equity of unlevered.
Yes. Kwa hiyo tujaachana mbali. Sawa, acha tumalizie basi. So, sorry. So the work of unlevered is the cost of equity of unlevered, ambayo tumeiborrow from here, just making K the subject of this formula. That's okay, right? Si hapo iko sawa?
Iko sawa.
Twende kwa levered farm.
Yes.
Twende kwa levered farm. Good. So let's see what levered farm is talking about. So we are now on MM2. Now the value of the levered farm inasema equals to value of unlevered plus, it's called tax shield on total debt. Tax shield on total debt. So every capital structure theory iko na approach yake. So where tax shield on total debt is simply equals to value of debt, you multiply by the tax rate. Remember, not after tax, not 1 minus t, it's times t. Hapo ndo wanafunzi wengi hunyoroshwa. It is value of debt times the tax on total debt. So that gives us the value of the levered farm, which is the value of unlevered. So everything originates from unlevered farm, because the difference between unlevered farm and the levered farm is the debt. So once you get the value of the unlevered farm, you can now get the value of levered by simply adding the value of debt times the tax rate. Tax shield on total debt. And also to get the WSCC of the levered farm equals to weight of equity times cost of equity plus weight of debt times cost of debt, but we have to adjust for tax. We have to adjust for tax. Asiweke kwa mdomo. Because now taxes exist, it's with corporation taxes. Corporation taxes. Good. Now, challenge inakuanga tu moja. kupata hii KE. Ili nipate cost of equity of the delivered farm under MM2, wanasema equals to cost of equity of unlevered farm plus risk premium. Cost of equity of unlevered farm plus risk premium. And now we calculate risk premium in a special way. Risk premium equals to cost of equity of unlevered minus cost of debt multiplied by debt over equity and we adjust for tax. Hiyo ni formula ya mwisho, nakwambia good night. Tumeanza kuonyesha the difference between advancing and baby class. So this is the risk premium, cost of equity of unlevered minus cost of debt. Usiogope, nika formula kadogo tu, times debt over equity into 1 minus t. Ukiishika umeishika, hakuna vile itakunjwa tena. That's the worst that can happen. So what does that mean? That to get the cost of equity of the levered farm, I'll get cost of equity of unlevered plus the risk premium, which is cost of equity of unlevered minus cost of debt multiplied by debt to equity ratio, and this one 1 minus t. Bora tu appreciate kwa E1 minus t, E1 minus t hai affect KE ya huku. It is.
It affects on the DE.
Sorry?
You are saying it only affects debt over equity.
No, it only affects the risk premium. It affects hii iko hapa mbele. Ona yenye nime highlight yote.
Oh, yes, yes.
It doesn't affect hii ya huku, the KE. Sawa.
So,
okay. So I think with that one, we shall consider these. We shall consider this question. We shall consider starting with this question of question 3 of November 2016.
November 2016.
Question 3. You can attempt question 3B because that is M1. Then we shall start with the question 3. We shall compare the notes. We shall mark it. Then we shall do question 3C as we conclude on MM2. Then I'll also check if there is any question on arbitrage. I'll share.
Sawa.
I think hapo tutakuwa sawa.